Thank you for watching this part one of our 10-part series called Voyage, which outlines qualified plans from even before implementation to closing one down and everything in between. This part will outline retirement plans and the categories of them. Hi there, my name is Kenner French, and I'm with Vast Solutions Group, where we combine tax, finance, and artificial intelligence to help entrepreneurs. Now, we do qualified plan consulting to include administration of 401k plans, profit sharing plans, defined benefit plans, and the list goes on. We've been in business for over 50 years and use artificial intelligence to better the entrepreneur's situation. I personally have been in the industry since 1994 and have written 2 books and have another on the way. I've written several articles on LinkedIn. I'm a Forbes.com contributor and also have done the same thing for the Palm Beach Times, so I consider myself an expert in qualified plans and helping entrepreneurs. Most importantly, I've been married for over 25 years and have a passion for helping entrepreneurs towards retirement. You paid $1,200 for this series, so let's get right to it. There are 2 basic categories for retirement plans. Number 1, defined contribution plans, and number 2, defined benefit plans. A defined contribution plan provides for an individual account for each participant. The value of the participant's account determines the amount of the benefits the participant receives in retirement. The employer allocates the contributions to a participant's account according to the formula stated in the plan. A participant's account is subject to certain expenses as well as gains and losses. There are several different types of defined contribution plans, such as an IRA-based plan, a profit sharing plan, a stock bonus or an employee stock ownership, money purchase plan, and probably best known, a 401k plan. IRA-based plans can provide employers with a simplified way to provide towards retirement. 2 of the most common are simple IRA and a simple SEP plan. Employers with 100 or fewer employees who've received $5,000 in compensation the preceding year can adopt a simple IRA plan, which allows employees to make pre-tax contributions to their employers to match employee contributions. The employer makes a 3% matching contribution to the employees who are making salary deferrals, or a 2% non-elective contribution, which, by the way, goes to the eligible employees, not just those who make the salary deferral. Under a SEP plan, the employer contributes to a traditional IRA set up for each eligible employee. All employees over the age of 21 who have worked for the employer for at least 3 years of the last 5 years and who receive at least $550 in compensation for the year are eligible employees and must be included in the plan. Employers can use less restrictive eligibility requirements, but not more restrictive in general. SEP rules allow the employer, including self-employed individuals, to contribute to the lesser of 25% of each eligible employee's compensation up to $50,000. Only the employer can contribute to the SEP, not the employees. Employers don't have to contribute at all, but each year they do make a contribution. All eligible employees must receive a share. The employer can't discriminate in any way over highly compensated employees. Employees own 100% of their SEP IRA balances. Now, profit sharing plans allow an employer to decide how much to contribute to the plan on a year-by-year basis, regardless of the amount or lack of profit for the year. The plan formula determines how the employer's contribution are allocated amongst the plan participants. A stock bonus plan is a type of a profit sharing plan, but here the participants receive in the form of employer's stock or in cash contributions, as it's called. An employee stock ownership plan, or ESOP, is a stock bonus plan that invests primarily in qualifying employer securities and places the employer's stock in the hands of the employees. A money purchase plan requires an employer to contribute every year, for example, 10% of each participant's compensation. The plan is subject to the minimum funding requirements, and it must provide for a life annuity as a distribution option. A 401k, you've probably heard, is a profit sharing plan that includes a cash or deferred arrangement that allows employees to elect to defer a limited portion of their salary as a plan contribution. All of these plans must meet coverage, non-discrimination, vesting and distribution requirements. Coverage and non-discrimination work together to require that the plan benefit a certain cross-section of the workforce in a non-discriminatory manner. This means the qualified plan must include some lower paid employees in addition to highly paid employees as well. Vesting means an employee's legal ownership of a contribution to the plan. An employee must be immediately vested in, always have 100% ownership, that means, of all his or her own contributions no matter what by law. Generally, distribution requirements mean 1. Restrictive on early distributions to preserve funds for later in life, and 2, to force out provisions later to ensure the funds are actually used in retirement instead of transferring wealth to heirs. A defined benefit, or DB plan, is a plan where a participant's ultimate benefits are determined by a definite formula stated in the plan. Sometimes a DB plan is referred to the type of benefit formula it contains, such as a flat, fixed, or unit benefit, but there is no standard definition for these forms. An example of a formula that may be used where an employee's benefit upon reaching retirement age is an annuity equal to 2% of a year's service times his or her highest 5-year average annual salary. Hopefully this part was a little bit helpful in teaching you a little bit more about qualified plans, and hopefully this voyage is going to indicate to you there are ways to make a lot of money towards retirement and lower your tax liability based on some of these concepts. If you have any questions in the meantime, please look us up on the web at www.vastsolutionsgroup.com or give us a call at 888-808-8278. We're excited to take this journey because we know it's going to add value. It's only cost you $1,200. What really this is going to bring you in value should be many times that. We work with a number of clients who've saved an incredible amount of money. We had one, as a matter of fact, a doctor who gave us this quote: "Over the years, I've saved over $1 million in working with us," meaning you, us, Vast Solutions Group. Now, would you be in that category? Do you want to be in that category? My assumption is yes. Thank you once again, Kendra French. It's been a pleasure talking to you.